Hi, I'm Kerry. I'm the host of Best of Us Investors, and I'm getting a little squeamish. I'm getting a little fearful of what I think is going to happen over the next year relative to the 2020 recession, if we want to put that label on it. There's some question, are we in a recession? Are we going into a recession? I think it's really irrelevant. It's going to happen. Whether we're there or not, we need to prepare for it. And so we need to think it through. And there's three elements of it. There's inflation, then there's interest rates, and then there's a Russian war. And I think we need to think through what are the overall effects of those three elements, and how is it going to affect the stock market, and how is the financial world going to react to it. And that's what I want to talk about today, because what I want to focus on is, what am I going to do about it? What am I, Kerry, going to do about it with my holdings in the stock market if I believe that there is a recession? And if I understand what the effects of the recession will be, how am I going to react? Am I going to buy? Am I going to sell? Am I going to hold? And what are my motives? And what is the best action I can take? So that's what I want to do in this video. And I want to put those three elements, inflation, interest rates, and war, into perspective, and then draw a conclusion of what's going to happen. Okay? That's what this video is about. First thing you need to do, though, is subscribe and understand this is not financial advice. This is financial education, and I'm going to give you the best I got.
Best of Us Investors presents Kerry Griegmeyer.
Okay, the first thing I want to do is to look at this chart. I think it's so important that we understand the history that has brought us to where we are so that we can understand where we're going. And what this chart shows you is the S&P 500 back to about 1982, about to 1980. And as you can see, the stock market just kind of danced along at a slow pace. And then with the digital revolution, the introduction of the internet, we had a surge. What you also got to understand is the introduction of the internet was also the introduction of globalization. We made it possible to communicate in an instant all over the world. That opened up supply chains, and we opened up markets. This is when we decided we no longer wanted to make my Nike shoes in the United States, and we wanted to make them in China so I could pay half price for them. That's when that decision was made. And you can see the exuberance over the thought of all this took the market skyrocketing, and then it collapsed. And then you see we got involved in some bad banking practices. That's what we should call the subprime crisis, bad banking practices. Put the blame where it's at. And people lost jobs and people lost homes. Nobody really lost homes back in the dot-com bubble, because that only affected people who had stocks and who were aggressively investing in the stock market. The subprime crisis was much more devastating because it took jobs away and it put people out of their houses. And then we were introduced to something called quantitative easing. And to make that really easily understood, it's the Treasury's ability to print money. And as you can see here on this chart, in 2008, we had, as a nation, because of this ability to print money to pay bills that we don't have money to pay, we had a national debt of $8 trillion. And we climbed along at a rate, and then in 2020, between March and December of 2020, we printed $9 trillion and distributed it amongst our citizens, our businesses, and 20% of it went to fraud. But that's another issue. We printed in 8 in 9 months as much as it took us 208 years to print before. So that's what took this market and drove it like a rocket headed for Mars. And now that's what's created the three things we need to talk about: inflation, interest rates, and the war. Yeah, the war had something to do with it as well. So that's where we're at this point. Inflation. What does that mean? That means that wheat is up 89% in the last year. 40% of the world's supply comes from Ukraine. Sunflower oil. Yeah, sunflower oil. Up 44%. 80% of that comes from Ukraine. That's the war, okay? But it's creating inflation. Palm oil. What the hell is palm oil? Made in Indonesia. It's up 87%. And half the items in your grocery store have palm oil. I want to share this with you because this is what's causing the inflation. Meat, poultry, fish, and eggs, when you go to the grocery store, they're going to be up 13%. Your overall food that comes into your home is up 11%. What this really means is that where it's important is not you, and it's not me. It's the people in Africa and the third world countries. Food insecurity has doubled to 276 million people. That's roughly the population of the United States, to give you some references, about 356. But 276 million people in the world don't have a secure source for food. And that's up 500% since 2016. Now, let's talk about fuel. Oil in the last year, up 49%. Natural gas, up 73%. Coal, nobody talks about coal, up 207%. Heating oil, that's going to be a subject come, what would it be? Probably next October, November. It's up 105%. So this is what's affecting our world. This is inflation. That translates into the stock market where I want to invest. Now, Ken Langone is about 9 years older than me. He had the good fortune of two guys showing up and talking to him several years ago and saying, we want to put Ace Hardware out of business. Let's start a place called Home Depot. Ken, we need some money. Ken was the investor. So here's what he has to say on inflation. This morning, I saw him on CNBC talking to Becky Quick.
He and I talk every day. And last year, we were both saying how insane it was that we weren't addressing the issue of inflation. I saw it in our truck leasing business. I saw it in our food distribution business. You could see it in the consumers' spending habits. Used cars are selling for more than they sold for when they were brand new. I mean, that's insane. So all the signs were there. And as I say, the safe course of action would have been to say, maybe it's transitory, but we're not going to take the chance that it's not. And we're going to put the brakes on. Now, would that have precipitated a recession? Maybe. But if it did, the recession would be less severe than the one that's coming by virtue of what we have to do now.
How inevitable is that recession in your view? Are we in a recession right now?
I think we are in a recession right now. I think intellectually and mentally we're in a recession right now.
It isn't going anywhere. It is a part of where we're going, and I need to accept that as an investor and then make my decisions how that I think that's going to affect the stocks that I hold. Stocks that I hold: Amazon, Google, Applesoft, Microsoft, Nvidia. If you're paying more for meat, poultry, and fish and eggs, 13%, you're not going to buy as much on Amazon. You're not going to do as many searches for women's blouses on Google. So their revenues are going to come down because of inflation. Interest rates. Let's talk about interest rates. The U.S. Treasury today is at 3.3%. About 2 years ago, it was at about zero. Okay? I believe it'll go to 5.13 within the next year. Okay? And then this will bankrupt a lot of the companies that you bought in SPACs. Remember that SPAC tsunami that we had in 2020? There's a bunch of them going to go bankrupt because they don't have the primary interest rate, which is right now at 3.3. They're probably paying about 8% on their lended money. Well, that's going to go up to probably 12%. So they're going to have a 50% increase in their debt service. That'll bury them because it's probably going to last at least a year or 2 years. So what I need to look at is my portfolio and say, look at their cash reserves. How much money do they have in cash? If I own a company that is not making money, do they have 2 years of cash that they can survive the next 2 years? Because those interest rates on that, if they have borrowed money, is going to go from 8, 10, 12%. There's going to be a lot of bankruptcies. So if you have stocks in your portfolio that don't have operating capital that can take them for the next 2 years, bail on them. Get out of them. Now, what about the 30-year mortgage? 30-year mortgage was down around 2.33%. It's now up to 5.89. It'll go to 8. It'll go to 8 probably within the next year. What's that going to do? Is that going to put anybody out of work? Well, it might hurt some real estate agents. But what you need to recognize is it will slow the real estate industry. But this is why Wall Street, and I told you about this about 90 days ago, was going into the rental home business. They're building homes in mass to rent, not to sell, but to rent. And that's why they're doing it, because they saw this coming. So the real estate industry is going to come to a bit of a halt. So because the young people who, 8% interest on a mortgage was a gift from God. When I bought my first home, I paid 14%. But the millennials, the Zoomers, they don't understand interest rates. They don't understand that if you're going to borrow money from me to buy a house that's going to appreciate, you should pay me 8% at least. But they don't understand that. So your real estate market's going to slow down. And so your millennials, rather than moving out of their parents' basements, they're going to move into one of Wall Street's rental homes, and mom and dad will help pay the rent. And that is what's going to happen there. Okay, so with that in mind, I need to recognize that interest rates are going to hurt the people, the companies that I own that aren't financed, and I need to recognize if I own any companies that are in the real estate business, that's going to slow down. Okay? So I've got those two taken care of. Now let's talk about the war. If you didn't read this article, it was actually in Sunday, June 21st, 25th paper. If you didn't read this article about how far do Putin's imperial ambitions go, I will give you a copy of it. I have turned it into a PDF, and in the description, I'll give you a link to this article. It will open your eyes. We as citizens believe that the Russian population is not behind Vladimir. We are wrong. The Russian population believes that the Soviet Union was taken from them. I didn't realize this, but prior to the breakup of the Soviet Union, Russia owned 1/6 of the world's dirt. That's right, 1/6. They don't anymore. The Soviet Union fell apart, and since that day, Vladimir and his cronies had made the decision, we're going to build an army to take back what is ours. And that's the path they're going on. Now, does it have anything to do with the world globalization? Yes, because Russia also, while they were building their army, they were harvesting their oil and their gas and making Europe dependent upon it. There's only one country over there, France, who gets 86% of their energy from nuclear power. Shame on the United States. We had the same opportunity. But Russia has them by the short hairs. They really do. England, not so much, but also Ireland. That Russia is in a position right now with their dependence on oil and natural gas and their nuclear arsenal to basically bring Europe to its knees. Now, the United States has pretty much said, we ain't getting in that nuclear war. They're meeting over there today, and I'm sure this subject is on the agenda. U.S., are you willing to have a contest of who pushes the nuclear button first? I think Joe says, keep me out of it. We're going to nationalization. We're going to eliminate our dependency on China, where we only get 4% of our oil from Russia, and that can change tomorrow. And we're out of this. We're going to become the United States of America, and we are going to depend upon our neighbors north and south, and your problem is your problem. That's the deglobalization, and that's what I talked about in my video where I covered Peter Zion's book, that the beginning of the end is just the beginning, or whatever it is. So, and if you want a copy of that free book, I'll put a link in the description so that you can get a free copy of that book yet. Amazon was supposed to have me a copy by Saturday, but it's not shown up yet. So Amazon maybe has some problems. I know the distribution center over here, the closest to me, they don't have the employees they had just several months ago. So that's my take on what's going to happen. And how I am going to invest is I will probably sell between 33 and 50% of my Google, Apple, Amazon, Microsoft, and NVIDIA before the end of July. Because I believe once we hit the end of July and they come out with their earning reports, the market's going to react negatively. As these other issues that I have talked about, I believe we've got a substantial cutback in the S&P, maybe another 33%, and I'm going to pick a bottom on each of these stocks and the other stocks I have, and I'm going to talk about it on our Friday afternoon Stock Talk. Our Friday afternoon Stock Talk is a time when our tribe gets together and we talk about things like what I'm just talking about now, and I invite you to join us and come spend a little time with other people who have a common interest with you to make money in what is going to be a very volatile stock market. If you don't believe me, look again at this chart and understand for every action, remember those balls that used to swing back and forth, bing, bing, bing? For every action, there is a reaction. Well, this spike from 2008 to 2022 is in the reaction state. We shot up, now we're going to shoot down. The only question is, how low will it go? If you want more education like this, subscribe, become a member, and join us at our Friday Stock Talk.